Traders, we know you like new, futuristic-looking trading indicators that give highly precise trade entries. That's the reason you're subscribed to Magic Indicator Strategies. You're looking for fresh ideas and technical tools that will help you earn money trading stocks, Forex, and cryptocurrencies. So we've done our research and found something truly amazing for you today. This trading strategy that we're about to teach you in this video has shown great success across multiple assets, so we're happy to share it with you. It requires only 2 free TradingView indicators. It works well on shorter time frames such as 3, 5, and 15 minutes, so if you're a day trader, this strategy is perfect for you. Okay, without wasting any time, let's open the Ethereum chart and start building our setup step by step. So, open the Indicators tab and search for the first indicator, which is called the RD, the Moving Average Official Indicator. Be sure to select this one created by Phoenix Binary. The RD Moving Average is a type of trading indicator that is used to identify trends and potential trading opportunities in financial markets. It is similar to other moving average indicators, such as the Simple Moving Average (SMA) and the Exponential Moving Average (EMA), but it uses a proprietary algorithm that is designed to adapt to changing market conditions. The RDMA is calculated by taking the average price of a financial asset over a specific time period, with more recent prices given greater weight in the calculation. The indicator then plots this moving average on a price chart, allowing traders to visually identify the direction and strength of the current trend. A 3-line strike reversal pattern and engulfing candles can also be identified using the RD indicator. If you don't know what an engulfing candle is, here's an explanation. Engulfing candlesticks are a type of candlestick pattern commonly used in technical analysis to identify potential trend reversals in financial markets. An engulfing candlestick pattern occurs when a small candlestick is followed by a larger candlestick that engulfs or completely covers the previous candlestick. In an uptrend, an engulfing candlestick pattern is formed when a small red candlestick is followed by a larger green candlestick, where the green candlestick's body completely engulfs the body of the previous red candlestick. This indicates that the buying pressure has increased and overwhelmed the selling pressure, potentially signaling a bullish reversal in the market. Conversely, in a downtrend, an engulfing candlestick pattern is formed when a small green candlestick is followed by a larger red candlestick, where the red candlestick's body completely engulfs the body of the previous green candlestick. This indicates that the selling pressure has increased and overwhelmed the buying pressure, potentially signaling a bearish reversal in the market. A 3-line strike, on the other hand, is a bullish or bearish reversal pattern in technical analysis that consists of 3 consecutive candlesticks with specific characteristics. The pattern occurs after an established trend and signals a potential reversal in the opposite direction. A bullish 3-line strike pattern is formed when a bullish engulfing candlebar is followed by 3 consecutive bearish candlesticks. As soon as this type of pattern has been found, the indicator prints a large size green triangle below the price bar. A bearish 3-line strike pattern occurs when there is a bearish engulfing candlestick that is followed by 3 consecutive bullish candlesticks. It is marked by a large red triangle on the chart. The RD indicator also includes a trend cloud. When the price is positioned below the cloud and the cloud is red, this is a strong sign of a downtrend. When the cloud is green and the price is moving above it, this is a signal of an uptrend. We will not use the trend cloud in our strategy, so let's open the indicator inputs and hide it. We also need to hide the table. Instead of the trend cloud, we will use an alternative indicator, which is called the Carril channel. So open the indicators menu one more time. Type Carril channel and select this indicator created by Gasanov Carril. Open its settings and change some parameters in the inputs. Change the first border offset to 2. The second border offset to -0.5 and the third border offset to 0. Then open the Styles section and disable everything except for the border top 3 and border bottom 3 lines. The Kirill channel is used to identify potential buy and sell signals, as well as to measure the strength of a trend. When the price of an asset moves close to or touches the upper band, it may be considered overbought and a potential sell signal. Conversely, when the price moves close to or touches the lower band, it may be considered oversold and a potential buy signal. In combination with the RD indicator, the Kirill channel can help us find really accurate trade entries. So how does it work? Well, the idea is simple. We will be looking to buy when the security is oversold in an uptrend and sell when the security is overbought in a downtrend. So a long position is taken when the following is met. First, the price and the Kirill channel need to be positioned above the RD moving average. Second, once the trend has been confirmed, we will be looking for a pullback into the lower Kirill channel band. This way we know that the security is oversold, yet the trend has not shifted to the downside as the price remains above the moving average. Last condition, a small or big green triangle must appear on the pullback. This is a signal to enter a long trade. Place the stop loss below the lower green band and target no less than 1.5 times the risk. It is important to note that this strategy works only in trending markets. That's the reason the Kirill channel should be positioned above the moving average when looking to buy. If the MA is inside the channel, then the market has entered the consolidation phase. No trades should be taken during this time. Let's take a look at another example of a long trade. We clearly see that the market is trending upwards. The price and the channel are above the moving average. We had a pullback into the lower channels band and a signal to go long. So all the rules are met. Traders, if you're enjoying the content, please leave a like to this video and subscribe to our channel for more strategies like this in the future. For short trades, do the opposite. First, make sure the price and the Kirill channel are positioned below the moving average. Second, we will be looking for a pullback into the upper Kirill channel band. Once we have that, wait for the indicator to print a red triangle. The size of the triangle does not matter. Set the stop loss above the channel upper band and target at least 1.5 times the risk. It is very important to follow the rules we just showed you, otherwise the strategy won't work. Try it on a demo account and see how it performs. Also, if you have any good suggestions on how to improve this strategy, let us know in the comments below. Thanks for watching this video, until next time.